Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we come to you through KCAA out in the Inland Empire, a great radio station that's been carrying our signal for about 9 years. And we bring to you information about mortgages, about real estate, about the state of the industry, both nationally, internationally, and, of course, the local programs that might help you get into that property that you want to buy. There's so much always going on in our business, and we want to bring that to you, and if we do, I'm glad, because that's kind of been the purpose of the show from day one. Bring you information so you can make better choices. Pretty simple, straightforward, and that's the approach that a lot of people in our industry have. There is certainly those out there who are interested more in the buck they make rather than the service they give you, but for the most part, people are interested in trying to see if they can help you get what you want, and in an ancillary way, get paid in the process. I'm Jeff Barton. This is The Mortgage Voice, and welcome to the show. Okay, so I have a lot of information here that I want to get to you. I have 3 sections to be able to do it, so I just want to kind of jump right into it. If you wanted to see this show afterwards, kind of catch up on what the information was, go to YouTube, Jeff Barton, The Mortgage Voice on YouTube. That's a great place where you can see this and many shows that we've done in the past and will continue to do into the future. That's Jeff Barton, The Mortgage Voice. It's on YouTube. First off, okay, there are comparisons between what's happening today in China to what happened here in the U.S. in 2008, 2009. Now, why do I bring up China as the first out-of-the-box topic in the show? Because if indeed there is a problem in the Chinese economy, which only a war will help, i.e. many things that we do in the U.S., if things are going poor in the economy and the current administration wants to make a splash other than that, they go foreign, right? Nixon opened China, okay? The invasion of different parts of the world under Bush. The number of other things that happen internationally to distract from what's going on at home. Well, that's why I bring it up, because if in fact, and we've heard rumors and we continue to hear snippets and sound bites about what may happen in the future with Taiwan and mainland China. If, in fact, there was an attempted invasion or a direct attack by the Chinese mainland on that part of the world, you will see real estate prices in the U.S., mortgage rates in the U.S. go to catastrophic levels and therefore kill what we have here currently, which is a pretty steadily increasing equity in your home type market, albeit not enough houses to sell. And certainly those people who are trying to get into that market are not happy at all. But for the most part, those people who are actually homeowners are liking it. But if we had something like that, it would be a disaster. So I bring all this to your attention just so that you understand what I'm about to tell you is what's happening in that part of the world, and then I'll tell you a little bit about what's going on here in the U.S. and how the two relate and how we can basically look towards markers to see where we are in our investment, in our buying and selling of houses, and how that might affect us and our decisions here locally. Okay. So many of you know, because we've talked about it here on the show many times, in the Chinese economy, what happened over the last 20, 30 years is that they lifted a great deal of their population out of poverty into the middle class. In order to do that, they had to deficit finance. What is deficit financing? Well, anybody who knows the U.S. debt, which is currently at about $32 trillion, and half of that has come about over the last 8 years. And all of that is about the government spending way too much money, more money than it has, and they have to sell bonds, treasury bills. That's why we in the mortgage industry always look to the 10-year to be the bellwether for whatever mortgage rates are going to be out there. But selling debt is the way things are financed and have been financed here in the U.S. for a long, long time. Ron Reagan called it, Ronald Reagan, I know I call him Ron. Ron was his son. Ronald Reagan called it trickle-down economy. the trickle-down economics, the supplied-side economics, which is really just supplying more money so that there can be growth. Well, in China, what they did over the last 30, maybe 40 years, is develop a plan by which they would lift all these people 400 million. It's no easy task, nor is it nothing to sneeze at as an accomplishment. But in order to do so, they built industries and they built housing on the back of borrowing money. Large firms in China, which have been doing that for generations, have now not now begin, but about a year ago, started to default on those debts. Corporate debt is called bonds, right? That's what they do. They sell corporate long-term debt. I don't know if anybody remembers Milken back in the 80s were selling junk bonds. He was the junk bond king, meaning that they would promise outrageous returns on corporate debt, 10, 15, 20%, and they would go out and borrow that money and put it towards whatever the company needed it for. Hopefully the investor would get paid off on the bonds, and all these things are related to Moody's and Fitch and all the credit rating agencies, which again has come up earlier this week when the U.S. was downgraded to AA plus from AAA status. That's another thing in its entirety, and we danced around with that during the Great Recession anyway. Anybody remembers the debt that was on the books of all the major lenders was really, it was bad loans, but the ratings agencies kept rating them AAA, so Wall Street gobbled them up, and it was one of the problems with the Great Recession at the time. So in China today, what we have is corporate debt, huge corporations. Now, you're talking about hundreds and thousands of projects across China not being built anymore. And as I told you in an earlier time on this show several weeks back, the Chinese borrower, the consumer, the person who's actually paying for the property, was to pay a mortgage on a property that did not exist yet. That's right, and that's what they were doing. Well, think about that for a second. So you're buying a new home, and they say, okay, you're going to give us a deposit of whatever it is. And anybody who's been around to these new home places, they know what the drill is. You put down a deposit, they give you a contract, you go through it, they give you incentives, they give you, mortgage, whatever the mortgage is that's current rate at the time, and they sell you the property. But they don't make you pay for that mortgage until the property's built. Well, in China, it was just the opposite. You would do all that, and at the same time, in order to maintain your place in line or to be able to get the order that you placed, you would have to pay for that mortgage before it was even built. So a lot of these companies couldn't pay their bond obligations. They stopped building. Well, obviously, if you're somebody who's waiting for a house to be built and you're paying a mortgage on a house that is yet to be built, and now that company has been declared insolvent because they can't pay their bond obligations, well, you're not going to pay that mortgage anymore. So this cascading effect times millions of borrowers has caused the entire Chinese economy to start to look like it's going to implode. I'm going to read you a couple of things here. I know reading on the radio is probably the least fun thing that you as the listener want to hear to, but it's interesting just because they can word things way better than I could about what is happening in China. Now, I follow it daily and weekly. If you go to any search engine and ask about the Chinese economy, if you ask about what's going on in the real estate sector, if you ask about bond defaults, any of those topics will get you to the same information that I'm going to try to get to right now. Quote, conditions in the Chinese economy are worse than the world thinks. And this is a self-exiled property entrepreneur, a guy named Desmond Schum, once head of the multi-billion-dollar development firm that he left in 2015. Sales across industries, even those thought to be insulated from any slowdown, are falling. And the economy outlook among Chinese consumers is so dire that executives are reporting blatant acts of theft by employees. Now, it's not like here with petty crimes affecting the businesses. There it's a very serious crime, and you go to jail for a long time. But because of the fact that there is such insecurity in the Chinese economy, because of the bond defaults, because of people not getting houses they already bought for, paid for, and were already paying the mortgages, it has caused the entire country and the entire economic outlook to look inward and say, hey, what is happening to what we're doing? And right now, they're trying to save what is left of their economic expansion. Now, everybody knows that in China, when you had expansion at 10 to 15% per year for 20 years, the economic miracle of the world. But it was deficit financed, and it was built on the back of investors who bought into the bonds being sold by these developers, by the builders, and backed by PBOC, People's Bank of China. PBOC is the main economic player in all of this, but every region in China, unlike here in the U.S., every region in China has their own banking status and their own ability to be able to generate mechanisms by which to raise money for builders. Okay, so all this is boring, I get that. But the situation there is dire. So you have to pay attention to it because you don't want to see aggression towards Taiwan. Because aggression towards Taiwan is going to mean that that $1 million house you just bought in Rancho Santa Margarita is going to be worth $600,000 the day after their invasion or the day after there is aggression. Why? Because stability in the markets are really a worldwide phenomenon. Financial markets do not react well to instability. That's why there's a constant pressure to continually invest. Because as investment goes, those that invest in the long term, in the stability of any country, usually are rewarded. Go back when I was a kid, the stock market was 802. 802. That's what it was. I'm 68 years old, so we're talking 10 years old, so 60 years ago. Do you know what the stock market is today? Yeah, about 35,000. So if you had invested at that time in secure, safe investments in the New York Stock Exchange, you would have seen that much, for, I don't know, what is it? What's 8 into 35? 7. So 7, 6, 3, 5, whatever it is, you're going to see a huge return. And that's what the market's like. They don't like interruptions with the outflow of cash from the government to the stock market. This is another thing entirely. But these things are things you've got to pay attention to. Now, what's happening in the U.S., real estate market? Okay, so let's look at the U.S. real estate market a little bit so you can understand the difference between what's going on there, the dangers there, what we need to pay attention to, and they're really doing what we did back in '08. They are way over leveraged. They built way too much. Remember, this is what happened in Vegas and Michigan and Arizona and Florida, way overbuilt. So all the properties that they had to in those states kind of plow under, and we really never caught up to the amount of properties that we need to buy. So what happens now in the U.S. real estate market? We're probably going to get to most of it in the next section. But so the real estate market currently, right now, in July, first part of August, we've seen a turnaround in what we thought originally in the first part of the year was going to be a recession and a downturn in real estate prices. Downturn in real estate prices, i.e. More product on the market because of that, drop in prices. We would see then the mortgage interest rates drop because we would need to stimulate. The bond market would also go down, the 10-year. Okay, so none of that happened. Just the opposite happened. We've seen less properties on the market. We've seen prices go up in 60 to 65% of the market across the country. And we've seen prices as a result of that really reaching all-time highs in many parts of the country. Now, what does that mean to you? I have a figure here that I wanted to quote to you about the amount of equity that's in properties in the United States currently. Okay, so where is it? It is not here for some reason. Anyway, here it is. The equity in homes, real estate equity in homes is number 4, and here it is. There's about $200,000 in equity in every home based on the amount that the property has risen this year alone. according to an article I saw in by Diana Olick, in Yahoo. And the interesting part of that is this is a trend that's supposed to continue. Good news if you own, bad news if you don't. Anyway, I'm Jeff Barton. I'm going to get to more of this. Got some great guests coming for you today. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, we are here and have been here on the air at KCAA for about 9 years. Really appreciate the people over there. But you can also check us out on the number of different podcasts that we have. Daryl, do we have a list of those?
We sure do, Jeff. It's a Spotify, Apple Podcast, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and TheMortgageVoice.com.
Yes, if you want to see and hear me, go to TheMortgageVoice.com. There's a number of different places to do that. But if you're looking for a central location to go and you want to hear a number of different podcasters that you probably aren't aware of but are excellent, go to podclips.io. They have finance, lifestyle, health, business, all kinds of different things that you can go to one place and get great information on podcasting. If you like podcasting like I do, that's a great place to go, podclips.io. Okay, I'm Jeff Barton. This is The Mortgage Voice. Really appreciate you all listening to me. With us, once again, is one of the show's favorite people to come on, really ear to the ground and boots on the ground out there in Rancho Santa Margarita. Is that correct, George?
Rancho Cucamonga.
How did I say Rancho Santa Margarita? No, it's Rancho Cucamonga. Maybe because I just visited there last week. Nice place. Anyway, it's George Gonzales, and he joins us now to talk a little bit about what's happening in the market. So tell us what is happening out there in your neck of the woods.
Hey, Jeff, thanks for having me on the show again. Sure. I really enjoy getting on these shows and telling you what's going on this side of the world.
Okay.
You know, in the Inland Empire area. It's basically across the board what's going on. A lot of people are on the fence. Buyers. I have many first-time home buyers who they're ready to go, but however, with the swing of the interest rates as they keep swinging up and down again, in the most recent, it started again. They had calmed down for a little while, but now they're starting to heat up a little bit. So a lot of these first-time buyers are trying to decide whether they want to pull the trigger now or hold off a little bit longer.
Right.
Even though there are a lot of new first-time home buyer down payment assistance programs that are becoming available.
All of these solutions that I think lenders are coming up with, I read today, and I forget exactly where it was, Yahoo or Housing Wire or Mortgage News Daily, one of these places, that said that the standards that lenders are using to dictate who gets a loan, even though the rates are higher, are also tighter. Is that true?
Well, I'm sorry, mention that one more time.
Are lending standards getting harder rather than easier?
The standard, you mean for the qualifying debt-to-income ratios?
Yes.
And yes, they are. They're squeezing the income. They're verifying everything, making sure that the borrower is indeed well qualified. There is that. However, again, like I mentioned, with these new programs that are coming out, they're basically giving a lot of these programs where you're coming back to zero money down again. But the difference is from prior, 2008 and all the madness, the difference between that one was they weren't verifying income like they,
Right.
and verifying everything as they are now. So crucial.
Yeah, I think the verification of income, I just worry because the internet is so proliferized, if that's even a word, with fraud. People that can make fake websites, fake W-2s, just sort of reinvent themselves to be something that they're not in order to get a loan. I've seen kind of an uptick in that, although not as bad as it was about 5 or 6 years ago. But I think the market itself, like you just said, is actually pretty good, pretty well positioned to be able to take on some of these stated loans. And I think that's what you're referring to in terms of programs coming back to the marketplace hadn't been around in a while.
That is correct. And, a lot of people are seeing that, FHA loans are actually a little less expensive on the payment versus some of these conventional loans going neck to neck. even with the MIP.
Okay, so let's talk a little bit about what's happening. Favorite loan that people are out there using now, is it DSCR? Is it more of a non-QM type product? Or is it FHA, like you just said?
Well, depends on who the buyer is. You know,
Okay.
for the investors, the DSCR is the number one route to go, because basically what the DSCR is the debt service coverage ratio loans. If you buy an investment property and you put enough down where the first on the monthly payment is not, if you can get more rent than the payment is, or at least 1% equal to the payment, then they will go ahead and they'll qualify you based on that. They don't even the banks aren't even asking for taxes, pay stubs, no verification of income or any of that, because they know, if you're putting some skin in the game, you don't want to lose that.
Right, and that varies too, right, with your credit score. If your credit score is better, you don't have to put as much down?
That is correct. Again, like I said, they'll give you a little wiggle room, but they still want the rents. They make you get what they call an 1120, I'm sorry, 740. I'm thinking tax. 740 something on the appraisal. It's for the rental schedule on the appraisal, and if that number exceeds the proposed monthly payment, principal and interest, and taxes and insurance, then they'll give you a little wiggle room if your credit score is higher to be over a bit.
Now, okay, so if you have this, you want to buy a house, you want to buy an investment property, but you don't have somebody who's actually renting it yet. How do they figure that part out?
Well, it's based off of the appraisal report, what the rent schedule comes out.
Okay, so the appraisal will be the person that does the rent schedule that will be able to get in that area, and that's what they'll go. Do they go 100% on the rent? Correct.
Okay. 100% on the rent or less, obviously. So, 100% max.
Yeah, that's a pretty good program. And qualifying, it's just simply your credit score, and the property has to qualify based on the rents they get. That's it?
They want the property, yes.
That's a very interesting loan. Who ends up buying those kind of loans in the secondary market? Do you have any idea?
I have no idea. All I know is that, at first, big banks, some of our top banks like Rocket Pro and AmWest, and actually AmWest is a very good bank for these type of loans, but like Rocket Pro and them were just basically for conventional FHA, VA, only, top tier files. They're noticing that these loans are starting to dominate the market, and they opened up their own form of DSCR as well, non-QM.
Huh, very interesting. Yes, I like the loan. I know a lot of people who have taken advantage of it. It's just you have to have the expertise and the knowledge to be able to be in the landlord business. I always caution people about that. It's like when you want to buy when you're going to get into a home, buy a mortgage, and you've been renting, you just have to understand that, there are differences. Renters do have some advantages. They can walk away and something breaks, they call somebody. If you are a homeowner, you've got some issues that you have to take care of. Obviously, the equity that you're building in the mortgage is unsurpassable as a renter. So that's always the best way to go, is to buy something. But there are some pros and cons both ways with either way you go.
Yeah, like I say in life, and like I tell my wife and kids, pick your poison.
Right.
Which one is going to be easiest or less painful? Yes, the one you choose.
Okay, so we've got interest rates, as you said earlier. We didn't quote the rate, but they're above 7%, and they're actually heading north, going to more towards 7.5%. Some of the borrowers are scared out of their minds. What are you telling them?
So if you've seen the jobs report, I guess it came out more than it did or less than it did, whatever it might be. We're at a 23-year high, or around the 23-year high in the interest rates right now.
Right.
The last time they were this high was in 1999 or 2000, I believe it was.
Right. And
we woke up today. Yesterday we woke up at 7.25. Today they kind of calmed down. We're just above the 7.125, 7.125, just a little bit less. And like I said, Jim, my main thing to the borrowers or to my clients is, look, guys, don't pay attention to the rate. Make sure, because the payment, when you see the interest rate, depending on the dollar amount, in reality, it's a couple bucks higher. It's just the thought in their mind thinking rate.
Of course.
But, I show them, like, more at a coffee shop every month for the difference of the rate that it was. $100 more a month because the rate went up a half a point or whatever.
Right.
Yeah, it doesn't seem good or whatever, but hey, it's going to be for your benefit. And then when the rates come down, I'm still here. I
Right.
should still be here. If God's good, I'll be here still, and I will be here for you to refinance whenever you're ready.
George, thanks very much. Good information. Could you let people know how they can get in touch with you out there in the IE?
Yeah, the number directly is 909-900-9565, George Gonzales.
George, thank you very much. That's George Gonzales from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week, month after month, year after year. We're bringing you really updated information based on the research that I do each and every week, canvassing both what I know in the industry, all the different lenders and mortgage lenders, as well as the news. And the news a lot of time affects rate because of the not only the proximity to money, and money really acts conservatively when it's under attack. And there are many ways by which money can be under attack. One of the ways has been recently the inflation, what's been going on for the past year and a half. All that seems to be better under control. Another one under attack, if money is under attack, would be a recession, which we've had a couple of the economists, both for the government as well as the one for Bank of America and the ones over at J.P. Morgan Chase, say that maybe the recession isn't happening. Maybe we're overselling what dangers the economy in. We seem to have some very good indicators from the government sources as well as business in general, whether it be what's happening with sales, what's happening in the labor market, what's happening in the overall economy in terms of consumer discretionary spending. All of these things have been pretty good. And I think the argument about discretionary spending, i.e., I have money in my pocket, let's go buy some Starbucks, that is always been at the heart of, the temporary good in the economy, whether you believe that or not, whether it's a Larry Summers thing or whether it's Ukatami, whatever that guy's name is, I can't even pronounce it. But anyway, another economist out there who would say, yes, it's because we have had the amount of money since COVID saved up, and we have trillions of dollars that are still able to be tapped into in the savings in U.S. Bank from COVID. And then the opposite of those people who would say, no, that savings has been spent, so we will see the demand for products and services go down. Well, what we have seen is the we have a guest joining us, I think, is Charles Giscombe from Malibu Funding, and he joins us now. Charles, how are you?
Outstanding, my friend. How you doing?
I'm just fine. If you could just speak up just a teeny bit, that'd be awesome.
No problem. I am actually going to... How is this?
It's better, yeah?
There you go. Sorry about that.
Oh, that's quite all right, and thank you very much for joining us. I was just actually talking about what was going on both locally here in Southern California as well as macroly, what's going on in the economy and the availability of funds and the attack on money, whether it's in a form of a recession or inflation or any number of other things, and whether the economy is doing well on one hand because of the savings within the COVID sphere and all that money that's still in the banks, or oppositely, that people say, no, all that money's been spent and the economy is actually pretty good. What are you seeing out there where you do business? And this is Charles Giscombe from USF, and we welcome him again. Thanks for coming on the show.
Hey, my man, Jeff, thanks for having me.
Sure.
What we're seeing out there is you're seeing the Fed's raise.
Right.
You're getting a hike. And what's happening right now is, once again, you have certainty in the market whether you should move forward. The reality of it is that the values are still maintaining themselves.
Yep.
So you still can transact. If you even have uncertainty with traditional banks, there are so many other alternative ways that are stepping up and stepping in, and allowing individuals to transact, especially in the realm of non-QM markets. You also have hard money renovation loans and commercial loans step into the plate, providing a service for individuals that are trying to get into the investment route that don't have traditional financing. And a lot of the business I'm seeing is people wanting to take advantage of this, of the money or the value in the properties. But what happens is they want to keep that first position loan in place. So you have these standalone HELOCs and these new HELOC products that are coming out that are allowing people to keep their low first position loans, but they're offering a lot of money to individuals to tap into the equity. The equity play is a big play in the industry right now. So I see a lot of people going in that direction.
You know, I look to employment as a major player in any loan, right? You want to make sure that the person who is getting the loan can repay it, and a lot of that has to do with your job, wherever you're working, and how much you're making. Do you see in general out there in the business world, what do you see on the street with people? Are they getting into business? Are they getting out of business? Are they afraid because of inflation or a possible recession? Or are they saying, no, business is great, I want to expand? Where are you in that? Because I know you personally are into a expansion mode with the company you're currently working at.
Correct. You see, one thing I am is a lot of people are at home, still working, doing more self-employed stuff. The employers are trying to get individuals back into the office, and I don't know how much luck they're having with that because everybody has become comfortable being at home. All right, but people are still working, and there's a lot more opportunity in jobs that are allowing individuals to work remotely. So I am seeing people getting back into the work field. They're just not getting back into the work field or expanding from a traditional standpoint. They're working from home, expanding their businesses from home, getting involved in many different jobs. So you have individuals that are getting income. I just have about 4 or 5 people that called that said they work for airlines or customer service or different things from home, and they're doing very well. And these are people that are trying to buy homes and that have the income, and since the pandemic have been able to show a constant 2-year history of working. So they can qualify for a loan. So I'm seeing a mixture of both of those things, Jeff, if that makes sense.
Yeah, it does. It does. Okay, let's switch gears a little bit and talk some about. We obviously never really get into what the commercial business is and how that is funded. I mean, we talk about downtown businesses and how a lot of major cities are losing office tenants and they have a lot of empty space within those buildings. But the commercial encompasses so much more. The small gas station, the 5-unit building. What are you seeing out there in that particular field as well?
You know what? There are so many loans that are now considered commercial by guideline.
Right.
What we think of normally as a traditional loan, which is a SFR, single-family residence, or a condo or a townhouse. But if you're buying it, you can buy it from a commercial guideline standpoint that doesn't require you to have so much traditional documentation. In many cases, you can get into a commercial loan, which can be a SFR, condo, townhouse, 5 units, mixed use, retail space, storage, or warehouse by simply just having a stated income and having a proper FICO score of a 650 or above. That will allow you to get financing for these properties. Obviously, the down payments may be a little bit larger. The interest rate might be a tad bit higher, but it provides you an opportunity to get into a commercial, a renovation loan, something of that nature, without the regular documentation that you normally would have. And usually that documentation is a difference that separates somebody from qualifying for a traditional loan or not.
And what are some of the advantages, and who would say would be interested in a loan like that? Would that be a business owner who may not want to provide all the documentation because however they're doing their own particular taxes, they're just looking at expansion of their business, buying another building? Or is it a consumer that might want to get into something but just get into it quick without having to wait all the time they need to do with a traditional loan?
It's Jeff, that's so great that Jeff just explained that. It's D. All of the above.
Okay.
You know how we're taking our multiple questions?
Yeah, I do.
It's D.
I do.
All of the above. All of the above. The reason why is because you have some self-employed individuals that will file their taxes, but in business they're writing everything off, so their income won't show that they're making the money that they're really making. That won't show the ability to repay. That individual can have bank statements and make a lot of money, but their tax returns won't show. That loan is for that individual. It's also an individual that doesn't want to show Uncle Sam what's under the hood. They don't want to show their tax returns. They just want to make it simplistic and take the path of least resistance of getting through.
Okay.
There are also individuals who have a business of real estate and have multiple properties. And these kind of programs allow individuals who have multiple properties not to take a hit, because these individuals can qualify for as many properties as they want in an LLC name with minimal documentation. And then you have some individuals that are very much so in the industry that don't mind doing debt servicing loans and servicing and coverage loans. So those individuals, they'll do multiples or apartment buildings, or just a regular individual investor that has a primary home that says, I want to get into investing, I want to buy a small home, I want to renovate it, and I want to get into the business. All of these individuals qualify for the commercial loan that Jeff was speaking of. That is a commercial loan by guideline standards. And so it doesn't have to be just an office building. It could be single-family residence. It can be an office building.
Right.
It can be a retail space. It could be a storage. It could be a warehouse. It could be a mixed use where it has business on the bottom or residential on top. Any one of those loans and any one of those individuals we just discussed can qualify for that particular loan.
Okay, so let's talk about the dreaded percentage rate that we have heard so much about. Now, I know that when we talk, we're more interested in, can you afford the monthly payment? What can we do to get you into the property? Let's start building some equity, and let's worry about the rate when the rate comes down. And if, in fact, it actually goes up, you're going to be doing yourself a favor by getting in now. The 7%, Maginot line in the sand here, what is the psychological significance of passing that 7%?
You know what, Jeff? We discuss this all the time.
Yep, we do.
7% was an interest rate that 6 years ago everybody would wish they had. Because
okay, yeah,
everybody wishes they had that, because that 6 to 7 years ago we were in 7s, 8s, 9s, and 10s and 11s. So those interest rates were available. It's just so recently, as of the last 6 years, that we've been very, very spoiled in regards to the all-time low interest rates. I don't think we'll ever see those all-time low interest rates again, but we will see low interest rates. But the 7% interest rate is an important number because it is the comfort line that we were in prior to us getting the all-time lows. So I tell people now, and Jeff says this to me all the time, are you interest rate conscious, or are you conscious about the check that you have to write every month? You have to be very mindful by saying I'm interest rate conscious, because there's many things out there and many different value-added services and types of loans that we can do that could make you write a check that was like a 5 or a 6% loan, but the interest rate may look 7, 8, 9%. So you have to really, really say the 7% loan. Yeah, it's high for what we've been used to, but like I said, 6 years ago it was normal. But if you have individuals that are experts that will take the time to walk you through situations such as Malibu Funding, and Jeff and his staff and team over there, or United Security Financial, what we can do, we can give you 40-year term loans that create a longer amount of amortization, which automatically will lower your monthly payment. So a person with a 7% loan that has principal and interest and has to pay mortgage insurance may be paying more of a payment every month than someone who has a 9 1/4, but they have no mortgage insurance. They're paying a 40-year amortization. That check writing might be the same or lower. So you have to be mindful of what you're saying. Are you interest rate conscious, or are you just, I'm conscious of the check that I stroke every month?
That's a great way to look at it. Obviously, it's something that you have to have a personal relationship with each and every person you talk to, customer-wise, to be able to get intimate with what is making them tick. What is it? Is it just that you have to go back to your family and say, I got under 7% to make them all happy? Or do you really want to look at what you're paying, what you're on each and every month as the driving force? And I think so many of us are driven by things other than what's in our best interest.
I completely agree with you, Jeff. I have some financial advisors that have to have the lowest interest rate,
right,
and they will go hell or high water to say, I'm a financial advisor, I would never take that. But the reality of it is if you're writing a lower check than a person who has a 7% and your interest rate is higher, you truly are the winner. And it just takes the professional and for you opening your mindset in order to understand that and receive that and an actual put that plan of attack to work.
Excellent. Hey, Chuck, I'm up against it. I want to thank you for coming on to the show. Really appreciate it. Congratulations on your new job. And if you could shout out a way by which people can get in touch with you, that'd be great.
Hey, you know what? I am used to saying Charles at Malibu Funding. Now it's Charles at usfhomesale.net. But I'm still at the 702-328-5191. Again, 702-328-5191.
Excellent. Charles Giscombe from United Security Financial. I really appreciate you coming on the show. Let's do it some more.
I appreciate you so much, Jeff. Thanks for having me again.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. I've just been shuffling through all these papers here. There's so much going on in terms of what I want to relay to you that sometimes I get confused by both my preparation and the questions and answers I want to give to you. But again, I'm Jeff Barton. This is The Mortgage Voice. Thank you very much for tuning in. If you want to see us on our website, it's themortgagevoice.com. You can go there. You can see not only me, but you can hear past shows as well as guests that have been on the show before. Any number of them are experts in the field. Give them a call. There's ways to do that if you go to themortgagevoice.com. I mentioned YouTube earlier, Jeff Barton, The Mortgage Voice. I mentioned our podcasts. We're on any number of, a million of them, and KCAA, the radio station. They're great people over there, and we've been with them a long time, bringing information to the IE, kind of my bread and butter out there, whether it's as far west as Covina or as far east as Palm Springs. We're kind of all over that signal, whether it's their FM or AM signal. So thanks very much for tuning in. Okay. What did you want to say?
I was going to say you had asked earlier what the frequencies were on the KCAA. It's AM 1050, AM 1050, and FM 106.5.
Excellent. Okay, thank you very much. And Saturday and Sunday, that's when the shows are. A lot of people driving around on Saturday, whether they're going to the hardware store or they're going to play golf or wherever they're doing and whatever they're doing, they can tune in to KCAA and hear us. This show, as you know, is constantly bringing news and updated information that'll help you better consider what your options are in the mortgage business. We try to bring both macro and micro here to the show. So let's get right to the last portion of it. 7.2 is the 30-year fixed rate loan. 6.6 is the 15-year fixed. 6.9 is the FHA. 7.23 is the jumbo, and 7.05 is the 5/1 ARM. The 2-year is at 4.885. Last week it actually flirted above 5%. And, you know, I have some savings, and I'm thinking 5%? That's a pretty good return. You know, on T-bills, you do the 2-year program, you get 5% a year. That's fairly good return. I mean, it's not as good as 20%, but if you're conservative and you're older, like I am, and you have a fixed income, but you do have a nest egg, 5% secure seems like a pretty good deal. Anyway, that's the 2-year. The 10-year. Let's talk a little bit about that 10-year. I've constantly told everybody in the audience on the show that the 10-year is the way you measure out what's happening with mortgage rates. And it is somewhat confusing at times to be able to understand that. So I felt like, okay, let's just explain this a little bit. It was a great article in Yahoo that I read about 2 or 3 days ago that explained it. I tried to copy it down, and so I can bring that to you. I do understand what it is, so we'll try to bring that to you. Investors that look to bonds, as I just said, the 2-year was at 5% last week. That's a pretty good investment. If you're looking for a 2-year investment at 5% a year, oh, that's excellent. You have $1 million over 2 years, you're going to make $100,000. That's pretty good. I mean, you can't really complain about an investment return like that because those kind of returns are excellent. But with institutional investors, those investors that drive billions and billions of dollars to different places in the economy in order to seek a return, and anybody who is worked for 40 years, has some kind of retirement account, a teacher, a doctor, a lawyer, anybody who's a public servant, all kinds of people from Congress people to bricklayers have investments in retirement accounts. All of these retirement accounts added up equal trillions of dollars, and they are invested by investment houses all the time in order to give you a return to make your retirement, what it's going to be, which is comfortable, hopefully. So in order to be able to understand where to put that money, the 10-year has always been a way by which you could say, okay, this is what the bond is for 10 years and what I'll be making. Now, how does that affect the mortgage rates? Okay, I'll tell you. When you are an investor and you're looking at mortgage-backed securities, when you do a mortgage, your mortgage, do a loan, they have to have a rate high enough to be able to compete with the 10-year. And because not only do you have to pay for the bond that you're issuing to compete with the 10-year, but you also have to pay the lender, the brokers, the fees involved, everything that's associated with the cost of doing that loan. That's why rates aren't the same as the 10-year. They have to put on there's an index and then there's a margin. So the margin that they need in order to cover their business expenses is why we have 7.2% interest rates. And that is a problem. So when you see the 10-year continuing to rise, it's a problem. And because that problem has been continually growing over the last year, that's why you see mortgage rates continually go up. When that 10-year goes down, which means that the demand for mortgage interest rates is so high that they can offer a lower yield, that's a good thing. Now, when does that happen? The 10-year demand happens when we're in a war situation, when we're in a situation like we had with COVID, with the pandemic, when we have uncertain times. The flight to treasuries, the flight to the dollar, happens in those situations. Now, we've had a lot of those over the last 5 to 7 years, and therefore you've seen mortgage interest rates fluctuate quite a bit. I have a chart here I'm going to get right to quickly. It's Freddie Mac's 30-year mortgage interest rates from January 2022 to July of 2023. I'll just hit some highlight moments. January of 2022, not that long ago, the mortgage interest rates were 3.45%. Okay? January of 22. Let's jump ahead to January of 23, 6.27%. Still better than they have been, but not as good as it was a year earlier at 3.45%. So let's jump to July. That's last month, 2023. Average 30-year fixed rate loan, 6.875. So we go from January of 22 to July of 23. We go from 3.45% all the way up to 6.85%. Now that is unbelievable. What we didn't have was an explanation of why they were that low to begin with. Artificial. Also, you had flight to safety during the pandemic. Both of those things kept mortgage interest rates at a historical low. You're not going to see it again. So when you're talking about interest rates today, what did I say? 7.2% for the 30-year fixed. These are still pretty good rates considering historically, but you're not going to see that 18-month gap happen again where you see low to high that quickly. 11 times since then. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, and we'll see you next time. This is the Mortgage Voice, and we are available on demand and on the air. Anytime you need to find the latest mortgage information, you can find us immediately on YouTube. Hey, we upload the show every week, and every week you can go there and find it. We shoot it for video, and we have audio. Just search for the Mortgage Voice, and you can also listen to the show on demand on your mobile device via any of our podcast partners, Apple, Google, Spreaker, IO Clips, Spotify, Stitcher, and more.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.